So this question is broken down into smaller parts. Let's make sure that we address each of those parts in turn. First of all, it says draft a report, and notice it says appropriateness of the format and presentation of the report and communication of advice is worth 2 marks. So we need to have report format, and it was amazing in the exam just how many students completely ignored that and therefore threw away the 2 marks. The answer report format is relatively straightforward. It's to who wants the report. It's the directors of Macaljoy. From accountant. No smart ass names, please. Just put from accountant. Subject. I've seen every name. I've seen Jabba the Hutt. I've seen the Queen of England. You name it. It's amazing what people think of. This isn't the middle of an exam. If you all put down Thanos' name, I'll know it's you if I'm marking, by the way. So, it says we're going to start off with defined contribution. And benefit schemes. So if we start off with the nature of the 2 schemes, if it's a defined contribution scheme, the employer and the employee pay in set agreed amounts. The pension received is determined by the success of the pension fund managers. The employee has all the investment risk. The accounting is simply to charge the employer's contributions as an expense. So that's our defined contribution. If we then turn our attention to define benefit, employer contributions vary due to the need to cover expected future liabilities. The pension paid is linked to salary and length of service. E.g., it might be 1.5% of final salary for each complete year of service. Actuarial gains and losses arise and are taken to OCI. Now, you could write pages and pages, but I'm looking at the question. The question says 7 marks. So I'm going to put, say, 3 or 4 points on each of. So that's the nature. Let's now do application. Yeah, but we've effectively said that in the first point. The employer's contributions vary, which is implying that the employer is the risk bearer. If we look at application, Macaljoy Plan A, this is a defined benefit scheme. Next word. Because, remember, because turns what's into whys. Because the employees have a guaranteed pension. Macaljoy Plan B this is a defined contribution scheme because there is no guarantee to the employees, and Macaljoy pays in a fixed amount to the scheme. So I'm trying as best I can to keep to my 2-line rule. Make a point in 2 lines or less. If you've got big handwriting, then it's 3 lines or less. But you know what I mean. So that's dealing with part A1. Next, let's take a look at the accounting treatment. So we've got Plan A or Scheme A. We've got assets and liabilities, and we're saying our opening balance. We've got an opening liability of 200. And we have an actual closing liability of 240. We've got an opening asset of 190 and a closing asset of 225. Our service cost, remember the service cost is the pension earned in the year, is 20, and we will debit that to the income statement. The pension paid reduces both assets and liabilities, and we've got contributions into the scheme are 17. The other side of that entry would be credit cash. We need to work out our returns. And it says the interest rate on high quality corporate bonds. Now, in theory, under the revisions to IAS 19, we should be using the same rate of interest on both assets and liabilities. Sometimes it will be different, but normally you'd expect to see it as the same rate of interest. So, our return on assets %5 of 190, which is 38, and the discount on the liability 5% of 200, which is 40. The return on assets, we credit to the income statement. The discount on liabilities, if you recall, we debit to the income statement. Actually, no, those figures are incorrect. That's what happens when I try to do numbers in my head. That's going to be 10 and 9.5. Yeah. So we can now work out our expected closing balances. Pardon? Doesn't tell us when the contributions are made. So if it doesn't tell you when the contributions are made, I don't think it does here. Yeah, always assume that the contributions are made on the final day of the year, unless you're told otherwise. $232, $42, Yep. 197.5. So this gives us that should be 211, isn't it? This gives us an actuarial difference. Liabilities are 19 more than we would expect them to be, and assets are 29. Having a bad day adding up. Sunday, my brain doesn't work on a Sunday. Our actuarial difference on assets is 27.5 gain, because the assets are worth more than we expected. And our liabilities, we've got a loss of 29 because the liability is bigger than we expected. So we've got an actuarial loss of 1.5. So if we look at the impact on the income statement, our income statement expense is the service cost of 20. The discount on liabilities was 10, and the expected return on assets take away 9.5, so that's 20.5. OCI, actuarial loss, we've established as being 1.5, and in the statement of financial position, we have a net pension liability, and it's the difference between our actual asset and our actual liability, so that's 225 less 240. We've got a net pension liability of 15. If we take a look at Scheme B, under the terms of the plan, Macaljoy does not guarantee any return. The company's obligation is limited to the amount that's contributed to the fund. We've simply got a pension expense of 10. The contributions paid to the employees come out of the employees' salaries. So it's actually included within wages and salaries, rather than as a pension expense itself. So it would not be included within your pension cost. It's already in wages and salaries, within the gross wages and salaries. That's what I've just said, yeah. So that is part A2. And all the time I'm referring back to the requirements. Section 3 of our report is to do with the warranty provision. It says, discuss the principles involved in accounting for claims. So this is warranty provision principles. for a warranty provision to arise in the financial statements, firstly, a legal or constructive obligation must exist due to a past event. Okay, so we've got a legal obligation is where something which is contractual. A constructive obligation is where you've got a public expectation. There's got to be a probable outflow of economic benefits. And thirdly, there must be a reliable estimate of the cost. Now, that can be an expected value, it can be a weighted average value. It's not normally something which will prevent you from putting in a provision. So let's relate it back. For Macaljoy, the legal obligation is created by the warranty in the sales contract. The company's extended the warranty for 2 years, and what happens? The probable outflow of benefits is the repair cost. And thirdly, Macaljoy has estimated the likely level of repairs. So the theory followed by the application. Try to link things in together as best you can. So that's our warranty provision principles. And then we come to accounting treatment. It says, shows the accounting treatment for the above warranty provision under IAS 37 provisions. So, under the standard warranty, we've sold 2,000 units and we've got 5,000 which are covered under the extended warranty. We can say that in total 7,000 units were sold. Therefore, the expected cost, and the standard warranty only applies for 1 year, the expected cost to Macaljoy of those 7,000 units, we'd expect 15% to have minor repairs. And those minor repairs come at a repair cost to the company of $100. So that's $105,000, and 5% of them we expect to have major repairs at a cost of $500. So 7,000. That gives us a further $175,000. So that's a total cost of $280,000. If we take a look at the extended warranty, $5,000 units are covered. So we've got 5,000, and it says in the question, Macaljoy estimates in the second year of warranty 20% of items sold will have minor defects. So it's going to be 20% times 100. So that is 100,000. %10 at 500, so we've got a figure of 350,000. So that gives us a total of 630,000. But because this is taking place over a period of time, the provision can be discounted to a present value. So it's going to be year 1 is 280,000 discounted at 4%. Which gives us a figure of 269,231. And in year 2, it's 350,000 discounted by 4% twice. Three, 2, 3, 5, 9, 5. So our double entry is we debit the income statement 592,826 and we credit provision 592,826. 6. So can you see that we've dealt with all 4 elements of the question requirements, and we've done the report format.